Global indices big move incoming? JUR 40, NAS 100, US 30, SPX 500 analysis. Please watch the full video. This is an educational video, not investment advice. Institutional market structure on SPX 500 presents a highly definitive bullish expansion on the hourly time frame. Following consecutive bullish breaks of structure visible on SPX 500, the current price action reflects a healthy corrective phase rather than a structural reversal. Heavy institutional resting liquidity resides above the key structural highs, framing our primary narrative. When analyzing the current delivery of price, the consecutive series of higher highs and higher lows demonstrates that institutions are aggressively protecting long positions. Retail sentiment often treats these corrective phases as complete reversals, but our structural tracking tells a completely different story. The downside move is lacking institutional velocity, showing standard volume deceleration as price moves into high probability discount areas. Our focus is on this entry zone, localized between 7,500 and 7,515. We are waiting for mitigation here to clear localized sell-side liquidity. Once price action confirms a bullish displacement, characterized by a sharp high-volume displacement candle leaving an institutional fair value gap behind, we can expect the upward move to start. Our invalidation level is strictly set at 7,420. If price breaks this on a sustained hourly close, our institutional bias changes completely. A clean break below this structural low confirms a shift in order flow, showing that supply has taken control of the market, and that further structural discount is required before any upside delivery can be anticipated. In our primary bullish path, Scenario 1 targets liquidity at T1 set at 7,600. This level contains major previous distribution and represents the first major sell-side liquidity pool that needs to be cleared. Scenario 2 extends the upside expansion toward T2 at 7,650, where trailing buy stops from early breakout sellers rest in abundance. Scenario 3 aims for final premium liquidity delivery at T3 at 7,700. Marking a complete expansion into new all-time highs. Alternatively, if structural invalidation occurs, the bearish alternative shifts focus. Under this secondary framework, Scenario 1 targets T1 at 7,420, Scenario 2 targets T2 at 7,350, and Scenario 3 projects downward acceleration to T3 at 7,300. A major higher timeframe demand level where large, commercial buyers are expected to defend the market broadly. The higher timeframe order flow on JUR 40 maintains a dominant bullish sequence despite recent short-term volatility as shown on JUR 40. Price has established successive breaks of structure, validating strong institutional demand beneath the current market price. Large pools of buy-side liquidity remain completely untapped above the recent structural highs, providing a clear directional magnet for smart money algorithms. When looking at the broader market geometry, the European index has been building a massive liquidity pool by leaving equal highs relatively clean. This structural building phase implies that institutions are accumulating orders below the market, preparing for an explosive expansion phase. Our focus is on this entry zone, established between 24,750 and 24,850. We are waiting for mitigation here to absorb retail sell-side stops resting cleanly beneath the local lows. This area aligns with a major institutional demand block that was responsible for the previous aggressive break of structure. Once price action confirms institutional accumulation through a lower timeframe shift in market structure, we can expect the move to start. Our invalidation level is strictly set at 24,750. If price breaks this key structural demand area on a sustained hourly close, our bias changes. A breach of this level confirms that institutional order flow has transitioned to net short, and we must respect the new market direction without hesitation. In our primary bullish path, Scenario 1 targets major overhead liquidity at T1 set at 25,100, which serves as the first minor structural supply level. Scenario 2 anticipates further premium expansion toward T2 at 25,400, clearing out a substantial pool of buy-side liquidity that has rested undisturbed for weeks. Scenario 3 projects a complete trend extension to T3 at 25,700, which marks the ultimate extension of this current hourly expansion wave. Conversely, if the market triggers a structural failure below demand, the bearish alternative activates. In this alternative script, short delivery becomes the dominant theme, as institutional algorithms target historical inefficiencies. Scenario 1 seeks T1 at 24,600, clearing immediate sell-side trailing stops. Scenario 2 targets deeper demand mitigation at T2, at 24,200. Scenario 3 exposes major historical liquidity at T3 at 23,000, representing a deep discount area where long-term commercial interest resides. The market structure exhibits an exceptionally aggressive, textbook bullish trend on US 30. The asset continuously prints consecutive higher highs and higher lows, heavily backed by persistent institutional buying pressure. No signs of structural distribution or change of character are visible, indicating that order flow remains firmly in premium territory. The Dow Jones Index continues to display incredible structural resilience, consistently breaking through minor retail resistance zones with massive institutional momentum. This behavior indicates that commercial entities are aggressively bidding up the market, utilizing every minor intraday dip to execute major block orders. Our focus is on this entry zone, identified precisely between 50,650 and 50,750. We are waiting for mitigation here, as the market seeks a minor technical pullback to rebalance efficient pricing. This zone represents an unmitigated institutional demand zone that contains significant unfilled buying orders. Once price action confirms a strong bullish rejection, signaling that smart money has successfully absorbed all retail selling pressure, we can expect the move to start. Our invalidation level is strictly set at 50,650. If price breaks this level decisively, our bias changes. Closing below this point proves that institutional buyers have abandoned their defense of this demand block, forcing us to stand aside and re-evaluate the structural map. In our primary bullish path, Scenario 1 targets immediate buy-side liquidity at T1 set at 51,800, aiming directly at the most recent swing high. Scenario 2 focuses on an extended upside target at T2 at 52,000, which acts as a major psychological round number and an institutional target. Scenario 3 projects an institutional expansion toward T3 at 52,300, delivering price into premium extension territory. If the market breaks the primary demand structure, the bearish alternative scenario takes over. Under this bearish shift, algorithms will begin unwinding long positions rapidly. Scenario 1 targets initial downside liquidity at T1 at 50,350. Scenario 2 targets intermediate demand at T2 at 49,750. Scenario 3 targets the lowest institutional pull at T3 at 49,250, completing a full structural market correction. The primary trend displays clear bullish dominance on NAS 100, marked by a robust series of structural breaks. Although price recently reacted lower from a major premium supply zone, this movement represents standard institutional profit-taking and healthy retracement rather than a cyclical market top. Structural integrity remains entirely intact until the nearest institutional demand floor is invalidated. The tech-heavy index is well known for generating massive liquidity sweeps before making its true macro moves. The current downside correction has successfully cleared out short-term momentum buyers, creating a clean slate for institutional accumulation. Order flow analysis confirms that buy-side interest remains incredibly strong on the higher timeframes, ensuring that the primary bullish narrative retains the highest mathematical probability. Our focus is on this entry zone, situated between 29,700 and 29,800. We are waiting for mitigation here to engineer a high-probability liquidity sweep that targets retail trailing stops. This zone represents a highly critical institutional demand area that aligned perfectly with previous structural expansion. Once price action confirms a bullish displacement away from demand, showcasing an aggressive displacement that overrides internal minor supply, we can expect the move to start. Our invalidation level is strictly set at 29,700. If price breaks this demand floor on a sustained hourly close, our bias changes. In our primary bullish path, Scenario 1 targets immediate overhead supply at T1 set at 30,500, clearing out early countertrend sellers. Scenario 2 looks for continuation toward T2 at 30,700, aiming directly at the premium institutional distribution zone. Scenario 3 projects full trend expansion to clear premium liquidity at T3 at 31,000, bringing price into uncharted territory. On the other hand, if a structural breakdown occurs, the bearish alternative scenario becomes operational. In this bearish framework, the market will systematically target internal sell-side liquidity pools. Scenario 1 seeks to capture sell-side liquidity at T1 at 29,700. Scenario 2 targets the next discounting zone at T2 at 29,400. Scenario 3 targets deeper institutional mitigation at T3 at 29,000, mapping directly to a massive higher timeframe daily order block. As we monitor these key macro levels across global indices, remember that patience remains your ultimate edge in smart money order flow tracking. Let the market sweep retail resting liquidity, look for sharp structural displacements at our predefined entry zones, and always manage risk relative to our strict invalidation levels. By remaining disciplined and waiting for precise mitigation at our defined levels, we align our capital directly with the footprint of the central banks and market makers. Follow for more. The next analysis is coming very soon.